So Myro is a reusable body care brand, and obviously we're all here because we understand the plastic problem. We just talked about it extensively. The way that we are reframing that problem is that there's a better way than a culture of disposability. Therefore, reusability is the solution. So to give you a sense of how we're approaching this, we're building a multi-billion-dollar brand that's focused specifically on body care, because anytime you walk into your bathroom, it's really easy to see the single-use plastic that's there. So we launched with a couple of categories, notably deodorant and body wash, and now we're expanding into 8 different categories of products. They all share the same characteristic. There's a reusable vessel that gets bought once, and then there's refills that are either plastic-free or plastic-reducing. So to give you a sense of quantifying what this looks like, I think Jake here mentioned that reusability is certainly a big trend, and we see people say that, and we see that in real data. So the expectation is the beauty category is going to be worth about $4 billion in a few years. Now, to give you a sense of our scale, so we launched in 2019 with a single category, just deodorants. To date, we've sold over 1 million units of the product. We're distributed in roughly 2,000 stores across the US. Happen to be the largest privately owned deodorant brand that's refillable, and we're just approaching and building distribution across partners that are, that move these products. So people like Target.com, Bed & Beyond, QVC, and the like. So one interesting insight that we learned along the way is that, again, to go back to some of the discussion that we had earlier, people who are interested in sustainable products are interested in these products, but they're not willing to change their habits. And what we found is that as long as the end behavior is the same as that they were used to, they're more than open to trying product that simply changes the way that they shop. And that seems to have been a big unlock for our products. So the way that we're building out a portfolio is based on 3 non-negotiable value props. The first one is there's a certain ingredient standard that we follow, and the products have to perform their basic function. At the end of the day, it doesn't matter how sustainable or reusable the deodorant is. If you stink, it's game over. So plant-powered ingredients and products that perform, that's one. The second one is we think that reusability and reusable packaging is this unique form factor that gets the best of both worlds, delivering the benefit while not changing your end-use habits. And by the way, we have 3 patents that we've gotten along the way just because we've been experimenting so much. And the last thing is we found that having the products look beautiful so that they're worth keeping is actually a really big deal. So here's an example of our core product. This is a reusable deodorant. Someone comes to us, purchases a one-time container that's meant to be kept forever, and then they purchase these refill pods that are inserted into the container so that you reduce plastic waste. That simple idea is a 50% waste reduction. Here's another example. This is a body wash based on a concentrate product. You purchase a one-time bottle. You then purchase an aluminum tube with a concentrate. You squeeze the tube into the bottle, you shake for 10 seconds, and you end up with a luxurious body wash. So no plastic, no water, no carbon spent on shipping the water around. Again, material plastic reduction. And we're just blowing it out. Here's a fragrance product following a similar model. So it's either the concentrate with an aluminum tube, or it's a refill that reduces plastic by the sheer idea of having a permanent container. Now, what we've learned about selling this is that it really takes an endorsement to sell a product like this, because we're dealing with categories that have been around forever. So we've attracted people like Serena Williams and Alex Morgan to help us spread the word. Once somebody tries it, we see that over 60% of people come back to us and purchase again, which is a pretty wild number given the fact that we're dealing with categories that are 100 years old. Behind the scenes, it's high gross margins. We're projecting LTVs of over $100. We're instantly profitable when sold to wholesale and already seeing very favorable paybacks. To put a sense of the scale, so we did about 2 million of the revenue last year. We're on track to do about 3+ change this year, and next year is really going to be an inflection year with some of the partnerships that are coming online. So the team is very small but very efficient, with folks that have done this before. There's about 8 of us, most coming from either CPG companies or direct-to-consumer companies that are basically hitting at our core strengths. And like I mentioned, we have the unique advantage of being able to bring some of the top celebrity names to help us spread the word, because it is a consumer brand. So what we're here to do is we're fundraising, and we're looking to fill about 800 that's left in our 2 million round, which hopefully gets us to get some of these new products out, look into some of the B2B revenue streams that are knocking on our door, and then get us to a Series A, which is the big inflection point for next year. Thank you.
Awesome. Very good. And without even needing the 1 minute stopwatch, because yours truly sometimes has a little bit of trouble with having everything there. But let me bring back the other investors. While we are doing that, I'm sure everyone that's watching is wondering how you had such high revenues previously, and then what the heck happened? Can you walk me through the COVID stinky explanation in terms of supply chains and deodorant?
Yeah, of course. So our first full year of business was 2019, and we came out of the market swinging. We did over 7 million in revenue in the first year. Unfortunately, we learned the hard way that when COVID happens and everybody goes into lockdown, nobody uses deodorants. So this is a real fact that I have real data to prove. So our supply chain, completely collapsed along with the demand in the market. So we had to, remarket, regroup, and just focus on diversifying our portfolio and focus on the R&D. But the COVID debacle was definitely something that was, a big trial and tribulation for me as a founder, and something that we've lived through and learned the hard way that, you need to have a portfolio of products and loyal customers in order to, grow and expand and build on early successes.
Thanks for clarifying that, and I found it funny too. Sorry, I don't want to laugh at your plight. That's one thing I found actually very impressive with Greg, was the fact that he was able to grow so quickly and then cut staff and keep things afloat and still have a business in a position today where it is a very interesting business. Something certainly we're looking at. Jake, do you want to kick things off this time?
Yeah, sure. So it looks like you've got some great distribution.
Mm-hmm.
Distribution can be expensive. Obviously, you've got to do activation and, as you mentioned, awareness. And it looks like you, of all people, and with the founding team, you get that. So I'm just keen to dig into why equity fundraising for this, because I know there are an increasingly innovative array of revenue-based financing options, which certainly for CPG brands can be quite attractive. So I sit on the board of a home care business in the UK, and they're utilizing revenue-based financing pretty successfully to minimize dilution. So just keen to understand what your thinking is around that. And then also just to understand about how you scale this and how you get throughput through this distribution, and how much you think that is going to cost you guys as a business.
Yeah, no, all very relevant questions, something that we think about every day. So to answer your question, equity versus debt. So we're looking at both is the answer. We're trying to sort of separate our equity capital that will go towards launching, the R&D behind some of these products and getting them out to the market. So the new launches are focused on, where the equity capital is deployed. And then the debt capital, which we're, sort of separately have vehicles for on the side, are mostly there to finance existing relationships and existing purchase orders. So we already have relationships with a lot of these retail partners. We already have, debt relationships with revenue-based providers that work and understand these kind of simple CPG businesses. So we're certainly focusing on both sides of the house. But the equity piece is much more geared towards the sort of the new product launches, where it's it's not as clear to explain to an old school entity how that facial wash comes to life, and that requires the equity capital. So hopefully that answers your first question. In terms of your second question, the capital requirements, and do we understand what's involved in kind of supporting some of these channels. So the way that we've always thought about the business is that it has to be an omni-channel business. What this really means to us is that we are using direct-to-consumer to self-pay for the marketing of the brand, of the product, and of the awareness. And here's a simple example. Best-in-class e-commerce conversion rates are 5 to 8%, which means that even on the best day, over 90% of people, come to your site, get exposed to your ads, get exposed to your message, but never transact. So with a wholesale channel behind it, with all these wholesale partners, we have a unique opportunity to funnel these 90% towards fulfilling that untransacted demand in retail. So the way that we thought about it is that direct-to-consumer is this giant marketing machine that happens to pay for itself, and then uses the spillover demand to drive trial at retail.
How are you currently?
Okay, I think that, sorry, I was just to close that off. I think that kind of makes sense.
Yeah, wrap it up.
But I think the challenge with big retail is it's easy to get an initial buyer to say, yep, love it, this is innovative, I can see how this fits in. But then to like activate that brand across a large geographical market like the US, it's paying for promotions, etc., offering them discounts, all of those sorts of things, educating users. And obviously it's more, you mentioned you got some impressive retention figures, but that's obviously more difficult to do when you don't control the whole customer experience at, say, a Target or wherever. So it's just more thinking about the question, sorry, is more how are you thinking about activating those B2B channels, and how much do you think that's going to cost you over there beyond just the seed round?
Understood. So in terms of the how, the number one thing that we learned about activating in these categories in general is that no amount of kind of splashy ads or just kind of flashy commercials actually work. It really truly does become about some sort of this endorsement by an individual and entity that you as a consumer trust. So all of our marketing is focused on endorsement-based marketing. And that means that the reason why we're going and getting, these celebrity investors and these influencers and working with DJs is primarily because we see that for 100-year-old, century-old categories, it takes somebody that you trust to say, hey, go check out Myro because it's better for you and the planet. So that frames how we need to think about marketing and how we need to think about activation. And by the way, we see that to be true across the category, irrespective of distribution. Now, in terms of the capital required to finance supporting these at mass scale, you're 100% right. This seed round is certainly just the beginning. The default plan is to raise a Series A, $5 to $7 million Series A in the summer of next year. Once we are, having 8 categories live, once we have run rate of basically $11 million, which we're projecting to 2023. And once we have some initial sell-through data, that puts us into that kind of ballpark of 5 to 7 million Series A, which allows us to then further support, the growth and the continued demand generation of those products. So certainly you're right on that.
Cool. Thanks, Greg. I really appreciate that.
So for what's the current split across those channels? I mean, I presume you started at a direct-to-consumer model, and then you've expanded to the wholesale, and then looking at retail. And then I guess secondarily to that question on the revenue model itself, on the former, perhaps it's distribution model, you also might have a subscription model that's built in there too. But as you go to things into retail, that would be more of just pure play distribution model. How are you thinking about that?
So in terms of direct to consumer business, I don't have the exact number of hand, but something like 80% of transactions are recurring revenue. So overwhelmingly people purchase subscription just because it's an easy one to subscribe. You get the permanent case once and then you just go on autopilot. It's just such a natural thing to do. So we certainly see that in D2C. In terms of the revenue split, the revenue ends up being very choppy because retail is just very choppy, right? Like no retailer orders on periodic basis with crystal clear clarity. It's always up and down, up and down. So when you zoom out, the revenue split is actually about 60% D2C, 40% retail, and probably over time it'll even out to more or less 50-50. But it's it's very choppy just given the nature of the channel itself.
What about B2B? Hotels?
So we've gotten a fair amount of inbound from B2B, especially in California and New York. There's a lot of legislation that's coming out because we basically have the packaging, the juice, the products. We've done, admittedly, very little on the B2B side. That's one of the areas that we want to double click with this equity capital, because people are knocking on our door and there's, people are being forced into this, and we kind of have 95% of the product, but we just haven't resourced it properly. So it's not a great answer, Matt, but this is a huge opportunity that we're sort of just haven't been able to address just given the sheer priority to date. But that's one area that we're specifically looking to do for the next 12 months.
Okay. If I gave you $5 million right now, what would you do? What would be your next steps?
So $5 million gets us to expands to about 12 products instead of 8. It allows us to hire a sales team that unlocks the hotel channel and the hospitality channel. And it allows us an opportunity to probably support a much bigger launch, which means a much bigger share and a much stronger velocity across retail. So we are in a, we're building a multi-billion global brand here, and demand and being first mover advantage in a lot of its categories is a really big deal. So developing strong relationships with retailers, showing them that we can support the launches with real dollars, with real material, real people, right? Like these influencers and celebrities, they all cost capital, but they are a necessary part of building a brand that then creates a flywheel effect. Because these retailers, they like to, double down on you and go in with one category, then the second category, and by the time you're done, you end up with a very material share of that shelf space, which builds on itself. So it just allows us to go much faster.
Okay. And going much faster, where do you stand in terms of the influencer, the athlete model, getting the big names on board and trying to get some traction? I know we talked a little bit about that, and seems to be a lot of potential.
Yeah, no, there's a ton of potential on that side. So like I said, we're working with already Carmelo Anthony is an investor, Serena Williams is an investor. We just brought on another kind of women's soccer player who's going to be closely associated.
You brought on the captain.
So we have we are true to what I said before. The strategy of endorsement being the lead marketing driver is something that we passionately believe in, because we see it, we just see it in data. So that's the model that we'll follow. And certainly as we continue to build the relationships with key distribution partners, as we build our direct-to-consumer business, it allows us to basically deploy that endorsement influencer strategy to a greater degree, because the names get a lot bigger with a bigger following, which allows the snowball effect to continue.